Hi, my name is Karmveer Minhas, and with my colleagues Christina Mazzocco and Ken Takata, we will help dissect that potential deal of Oracle acquiring Sun Microsystems. Next slide. We will start by going over the core offerings of Oracle and Sun Microsystems to get a better understanding of how Sun Microsystems would fit into Oracle's portfolio. From there, we will determine Sun Microsystems' current value, perform multiples analysis using the various sales and EBITDA assumptions, review potential synergies and the effect on Sun's forecast, and then finally calculate the maximum amount that we would recommend to pay in case a competitor does outbid our initial offer. Next. Over the last 3 to 4 years, Oracle has spent over $30 billion in acquiring software and solutions companies to expand their portfolio. This has made Oracle one of the biggest suppliers of commercial software. Although at first glance, Sun Microsystems seems to be the odd company out. From a strategic standpoint, Sun Microsystems would be the perfect fit for Oracle. The merger would combine Oracle's dominant position in software space with Sun's expertise in hardware and networking. This also brings their CEO Larry Elstein's vision of transforming Oracle into Apple much closer to a reality. The combination of Oracle's databases and Sun's servers has already driven both companies' sales for much of the previous decade, and has allowed them to unite against Microsoft, the second largest software provider. Oracle could capitalize on Sun's customer base and service contracts by adding Oracle's software deals with them. By being able to bundle the software and hardware, Oracle would be able to cut their costs and compile an entire system with better pricing than its competitors. The icing on the cake with this deal would be the addition of Java, MySQL, and Solaris to the Oracle portfolio. This is a major plus because Oracle systems are already built using Java and run on Solaris operating systems. The addition would allow Oracle to service both their current high-end clients as well as the small businesses with MySQL. To place a value on Sun Microsystems, we will use the standalone value using the income and market approach. We will then determine the present value of Sun Microsystems before considering the synergies from Oracle. We will then calculate the value of Sun Microsystems with synergies from the acquisition, and the best way to calculate these values is by the discounted cash flow valuation. With this, we can determine the required rate of return, the base case cash flow, and our estimated terminal values. Christina will now help dive deeper into the valuations.
Next slide. Before we could value Sun Microsystems, we first need to determine the weighted average cost of capital for the firm. This value is the same return that we should expect to receive if we are to move forward with acquiring Sun Microsystems, so finding this value serves dual purposes. First, to determine the cost of debt, we used the current yield to maturity on firms with comparable bond ratings. This gave us a value of 11.42%. Next, we arrived at the cost of equity using the capital asset pricing model, which included information provided by Madison's team. For the risk-free rate, we referred to the 30-year U.S. Treasury yields, which are currently at 3.66%. We estimated a market risk premium of 6.34% by using the average return of the S&P 500 index, which is approximately 10%. This gave us an overall cost of equity of 14.63%. We determined the current capital structure of the firm using the firm's book value of debt and market capitalization of their equity. Combining the cost of equity and the cost of debt based on this capital structure at a corporate tax rate of 35% gives us the weighted average cost of capital of 13.17%. Next slide. Next, we performed a discounted cash flow valuation using the projected earnings we received from Madison's team. These earnings were adjusted to free cash flows to the firm for the years 2009 to 2014 to find the base cash flows shown here. As you can see, although the firm has significant negative cash flows in 2009, our calculations, along with Madison's analysis, show positive cash flows beginning immediately in 2010. Using our calculated weighted average cost of capital and assuming a long-term growth rate in cash flows that matches the growth in projected net revenue in 2014 of 2.6%, we arrived at a terminal value of approximately $6.3 billion. The terminal value is essentially a perpetuity valuation of the company's cash flows beyond 2014. To find the enterprise value of Sun Microsystems, we need to calculate both the net present value of the base cash flows and the net present value of the calculated terminal value. We combine these values with the current cash and cash equivalents of $3.061 billion to arrive at an enterprise value of approximately $8.4 billion. This represents what we believe to be the total value of Sun Microsystems. To determine the value on a per share basis, we subtracted out the total debt from enterprise value to arrive at the equity value of almost $7.2 billion. On a per share basis, this is equivalent to $9.69 per share, which is significantly higher than the current market price of $6.69 per share, and also somewhat higher than our current offer to Sun Microsystems of $9.50 per share. Next slide.
We also approach the valuation with the popular comparables analysis or multiples approach. This simple but useful analysis methodology helps us to estimate value by comparing specific pieces to a company's firm's financial makeup with other similar firms. As Sun Microsystems is one of the larger players in the hardware space, we conducted the multiples analysis using 6 comparable hardware firms, using the last 12 months of revenues, EBIT, and EBITDA to compare. Our team looked at Advanced Micro Devices, Apple, Dell, EMC, Hewlett-Packard, and Intel. We then took the average of all of the studied multiples as our selected multiple for the industry and applied that to Sun Microsystems. The analysis showed that Sun Microsystems has a value per share of $11.98. In addition to the multiples, the potential synergies in the proposed acquisition provide the possibility of adding good value to Oracle. Synergies exist both in the cost reduction as well as revenue generation areas. We estimate the proposed staff reductions at 22% and the SG&A reductions at 27.5%. While cost cutting will be the most believable to our investors, the added revenue generation is also exciting. Sun Microsystems currently gives away their open source software. Our market research shows customers will be willing to pay a fee for that software. In addition, the combination of our technologies allows for the creation of a new Exadata machine that will be fastest in industry and twice as fast as its predecessor. This football chart puts all of our analysis into one graphic. We have Sun Microsystems' current share price of $9.69, Oracle's current offer of $9.50, followed by the range of the discounted cash flow analysis from a standalone firm to the value of our estimated synergies. And at the top is the range of the multiples analysis, also from a standalone firm and after estimated synergies. With the potential synergies of cost cutting and revenue generation, we believe that this deal would benefit Oracle as long as the price remains below $12.95 per share. Our companies have a history of working together, and our expertise complement one another. Bringing Java, MySQL, and Solaris to Oracle's portfolio would help Oracle bring in clients at multiple price ranges. Oracle's dominant position in the software space and Sun's strong brand in the hardware and networking would bring the CEO's vision of transforming Oracle into the Apple of the business world a reality. On behalf of Karmbir and Christina, myself, thank you for listening.